Right, we are live. I will just wait a few seconds to let people trickle in. In the meantime, as you come in, please introduce yourself in the chat. Say hello, where you're tuning in from. Let's be social. Remember to switch your message to all attendees so everyone can see it. And we'll kick off in a little bit. Some great attendance today. Right. Well, we can definitely kick off. So, hello, Finimizers, and welcome to another Finimize Live. My name is Reda, analyst here at Finimize, and I'm absolutely delighted to host today's event on your 2025 Playbook Opportunities Investors Need to Know with our partner, Charles Schwab. First, just some housekeeping rules. Like I said before, please, as you're coming in, say hello, introduce yourself in the chat where you're tuning in from, and remember to switch the message to all attendees. Second of all, as you come in, you're going to see a poll on your screen. Please take some time to fill it out. It's super quick, just so we can get to know you a little bit better. Third of all, in terms of format, today is going to be a 15-minute discussion with our guest, followed by a 15-minute audience Q&A, which takes me to my fourth and final point. Please use the Q&A box down below in Zoom to ask a question. And if you see a question that you like, upvote it. So it moves up to the top, and that way we get through the most upvoted questions first. So without further ado, let's kick off. Like I said, our partner today is Charles Schwab. And at Charles, they believe in the power of investing to help individuals create a better tomorrow. They have a history of challenging the status quo in our industry, innovating in ways that benefit investors and the advisors and employers who serve them, and championing their clients' goals with passion and integrity. You can find more information about them on their website as well as on their social media. Now, that out of the way, I'm excited to have Charles Schwab Director and Senior Investment Strategist, Kevin Gordon, with us today. So, Kevin, in addition to analyzing the US economy and stock market for Schwab's clients, Kevin helps develop content and deep dive projects for Schwab's public website, internal business partners, and social media outlets. Kevin is a frequent guest on CNBC, Bloomberg, and other big channels that I'm sure you've heard of. Kevin, great to have you with us today. How are you doing?
I'm good. Yeah, thanks for having me. Delighted to be here. And I love seeing the all the comments roll in and where everybody's from. This is such a fun this is really fun, diverse group. And I even saw Hong Kong. So thanks for braving the time difference, whoever's tuning in from there. But that's always fun to see. So thanks for having me.
It must be really late in Hong Kong, so hats
Yeah.
off to that person. Thank you very much. Right. Without further ado, let's kick in. Lots to talk about as we enter 2025, Kevin. But first, before we talk about 2025, I want to reflect a little bit, if you will, on 2024. And looking back at last year, what were some of the most surprising market and economic developments in your opinion?
Yeah, so and just for everyone's clarity, I focus on the U.S. Market and the economy here. So my all my remarks will be focused on that. That's what my 2024 look back focus will be. I'll say from an economic perspective, what was really impressive and surprising to me and to all of us at the firm, that cover this, is that when you look at some of the indicators that started to crack and show more traditional recession signals, not just in 2024, but dating it back to 2023, whether they were in the labor market, whether they were in some of the survey-based data that we track and look at as leading indicators for the economy. A lot of those did weaken, but they didn't kind of make it into traditional recession territory, and they didn't bring the broader economy or the broader labor market down along with them. And I think that if you were to put one blanket term over the economy for the U.S. for 24, it really was soft landing. And we have a more nuanced way of looking at soft landing versus recession. We think in many ways there were rolling recessions that hit the economy and certain parts of the economy at certain times, but you had nice offsetting strength from services, nice offsetting strength from the labor market, and it really made for in many ways, a totally unique cycle, something that we have really never seen, in the U.S., really have never seen in the West, when you go back in the history of the economy and all the data that we have. So definitely a good surprise, definitely an upside surprise, but one that really was impressive to me. And similarly, on the stock market front, There was this really interesting dynamic where at the index level, so think, S&P 500, NASDAQ, Russell 2000, Dow Jones Industrial Average, at that level, the maximum drawdowns for the market were not really that large. So if you think about the S&P 500, which is really the standard benchmark for the US, the max drawdown for the S&P last year was just 8.5%. So you didn't even get to technical or traditional 10% correction territory. But if you actually look at all 500 members in the S&P last year and you average what their maximum drawdown was, and I do this data every single morning. I run this data every single morning. If you average that max drawdown, it was 21%. So you had bear market like declines at the average member level, but you didn't have it at the index level because there was all of this churn and rotation happening under the surface. It just wasn't filtering up to the indexes. And that's a really remarkable thing when you think about it, where, some names had worse, much worse than 21% drawdowns. In the case of the NASDAQ, the average member's drawdown was 50%. So you had a lot of this weakness under the surface, was just being masked by many times the mega cap names, the Magnificent Seven, whatever, moniker you want to use. And that kind of kept indexes afloat and made for a relatively good year, at least if you were looking at it from the standpoint of the index. So I just think that in keeping with kind of what was happening in the economy, where there was this weakness under the surface, the market was also reflecting that. And I find that to be quite surprising and also really impressive.
Yeah, but I have a very quick follow-up question on that. I couldn't agree more that, the best way to sum up the economy last year was soft landing. But if you remember at the start of 2024, everyone was talking about hard landing and there was a lot of worries about a potential recession. The economy ended up surprising everyone essentially. What, in your opinion, kind of drove that resilience in the US economy last year?
Well, I think that a lot of it just had to do with the unique nature of the pandemic itself. Nobody, wants to relive what happened in 2020 and 2021. But if you think about how the world, but in particular the US, really kind of shut down operations almost instantaneously, where we were all confined to our homes, literally and figuratively. That put immense pressure on the services side of the economy. We couldn't go out, fly, eat at restaurants nearly as much as, we wanted to or could beforehand. So that almost artificially, in a way, propped up the manufacturing side of things, the consumer goods side of things, because we were, shipping a bunch of stuff to our house and we were spending all our money there. Conversely, when you look at when we reopened, and in the US, it was a little bit faster, compared to the rest of the world, largely. Obviously, there are some exceptions, but especially if you compare it to something like Asia. When you look at the speed with which we did reopen, that shift brought all of the money that we were spending on goods and manufacturing and even housing, and it put it right into services and labor almost instantaneously, about as quick as you can get in terms of snapping that data, month to month. And what that did was, yes, prop up services and labor, but then it sent all of the manufacturing and the consumer goods and the cyclical indicators that we look at deep into recession territory because of the rapidity of that shift. So if you were just focusing on those indicators, then you would say, well, of course we're going into a recession. These are the classic leading indicators. It's housing, it's housing sentiment, it's actual home sales, it's manufacturing sentiment, it's actual industrial production. All of that was showing you that we were going into recession just because of rate of change. But again, what wasn't being kind of looked at as much was the strength and the resilience of the services economy, which is 70% of the US economy. So if you've got services demand really strong, services labor really strong, and then by virtue of that, spending from those sectors also really strong, it's pretty hard to put the US economy into a recession. So I think that's really the nature of the story or the backdrop and why things have been so resilient. Obviously, now that has kind of subsided and hopefully we're getting back to a little bit of a balance, but we're still dealing with ripple effects from the pandemic, even, almost 5 years later, which is kind of crazy to think.
Absolutely. Absolutely. Thank you so much, Kevin. That all makes perfect sense. Okay, now I want to shift gears because, as we all know, investing is less about history and a lot more about the future. And I want to kind of focus on 2025 and where, in your opinion, do you see kind of the most attractive investment opportunities for this year?
Yeah, so our focus has been a lot more on factors as opposed to traditional sectors. And what I mean by that is, if you look at the 11 sectors that are covered in the US, everything from tech to communication services to industrials to financials, the typical and traditional way of looking at the market and looking at attractive opportunities is having ratings on those sectors, which we still do. So we've got, formal ratings on communication services and financials as our two outperforms. And then everything except consumer discretionary is rated as a market perform. We've got consumer discretionary rated as an underperform. So they're right right there, you could look at, okay, we're pretty optimistic on financials, communication services. We're pretty, pessimistic on discretionary. We tend to take it, one layer further, especially for investors that are a little bit more active oriented or maybe have a little bit more of an individual stock or industry bias, meaning if you're looking at factors or characteristics of companies or of industries like strong free cash flow or really strong cash positions or high interest coverage ratios, high profit margin guidance and really strong revenue guidance and so on and so forth, those all of those that kind of live under that high quality basket or high quality moniker, that's been a more consistent way to invest since the pandemic. Because really, since the bear market in 2022 that we had in the US, I'm in many places around the world, but since the one that we had in the US, over the past few years, there have been these really large and rapid and really intense shifts in sector leadership at times. So you'll go from, tech carrying the baton for a couple of months, and then it quickly reverses to, the bottom of the leaderboard the next month, and then all of a sudden energy is on top. And I think it's, part and parcel of what this environment from an economic sense has been over the past few years, which is extremely volatile, albeit if it's relatively calm on the surface, you still have, per the discussion we were just having for the first question, you still have a lot of this churn that's going on under the surface. So I think because of that, you're probably going to still see these really rapid shifts in leadership. And just to kind of give an example, if you look since the bear market low in October of 2022, some of the most consistent performance across every single sector has been, companies with strong profit margin estimates, companies with strong profit margins, but also forward estimates picking up. And then companies with strong interest coverage ratios, because you want to be able to invest in a firm or invest in an industry or a sector sometimes, but mostly just an industry or an individual company that has those strong characteristics that is really not as susceptible as rates staying elevated or moving higher. So you can find those companies in discretionary and tech and energy and staples and healthcare. Doesn't mean that we don't think investing based on sectors is a good thing, but because of the unique nature of this cycle, we've been a little bit more characteristic and factor focused. So that high quality view from our standpoint has not changed, and if anything, has been more reinforced, further reinforced, just because of where we now find ourselves with the Fed probably staying, on hold a little bit longer and then keeping rates a little bit more restrictive.
Makes perfect sense. Thank you very much, Kevin. Before I move on to the next question, just a reminder to everyone, if you have questions for Kevin, be sure to add them in the Q&A box in Zoom, and we'll get to those shortly. So, Kevin, we cannot, talk about the US market these days without talking about AI. Obviously, a lot of investor excitement over there. Kind of what I want to figure out or get your opinion on is, do you think the AI frenzy still has room to run, or do you think the theme is due for a potential correction in the near future?
So I think it has, it depends on how you define AI and what parts of the market are considered AI. And I probably have a little bit more of a, hopefully it's not too cheeky of a response, but I was having a conversation with a friend recently about this, and we were kind of going back and forth and quipping, if AI is kind of touching every part of the market, then shouldn't you just be investing in the market? Meaning there's not really any specific part of the market that is benefiting from it at the expense of another, because you could easily look at, AI creators. So obviously the big tech names and the chip names get a lot of focus for that. But then you could also look at AI adopters. Companies that don't have to invest heavily and don't have to go through that big CapEx spend on the front end, but can maybe benefit from having all of these choices and selections in front of them, and basically like a shopping market, saying, okay, where can I, what technology can I use to improve my business, improve my bottom line, maybe pad my margins more. So, and I think back to the outlook we wrote for not 2025, but for actually 2024, after you went through that AI frenzy from a tech sector perspective in 2023, a lot of our focus was, okay, how can the adopters really implement this and benefit from this, moving forward? So I am just as optimistic, if not more, on companies that can implement technology, than I am, for companies that are kind of at the forefront of it in manufacturing everything. All that to say is that, I don't think that there's one particular sector that will just completely outpace everything else, in the coming years. And if you want to use a lot of times people just tie the Magnificent Seven to AI, in particular. The one thing I would say is that, that group is not immune to drawdowns and not immune to corrections. I mean, the Mag 7 almost had a 20% decline last summer, and it was pretty swift, and the recovery was also pretty swift. But keep in mind that, that group of names, or the big tech names, or the communication services names, or the consumer discretionary names, which is Amazon and Tesla, they can go through some pretty swift and severe corrections. And definitely you can catch upside, but just understanding that they're not immune to corrections over time, which I think is a healthy thing because it sort of keeps, sentiment in check, and it keeps frothiness kind of lower. But I would just, be maybe just cognizant of the fact that they don't, they're not immune to corrections. They're not immune to drawdowns.
Makes perfect sense. Thank you very much. And speaking of drawdowns, I think perhaps final question before we move on to audience Q&A. We talked a lot about potential opportunities, but no investment discussion is complete without talking about potential risks, right?
Yeah.
So I want to kind of get your thoughts on that, where you see some of the biggest risks or headwinds in 2025, and perhaps more importantly, what investors can do to mitigate some of those risks.
Yeah, so I think, obviously what has gotten a lot of attention, not just in the US, but around the world, has been the election, the presidential election here. And, I think from a policy standpoint, typically there's not too much focus from the investor world on specific policies and, what they're going to mean exactly for certain parts of the economy. But there's a little bit of it's different this time, verbiage in the mix, I think now, because the policies are so grand, and they're very, in terms of scale, they're pretty huge in terms of what, President-elect Trump, soon to be President Trump in, 6 days, has been proposing. And, the main focus from our standpoint, at least initially, mostly because of what can be done unilaterally and doesn't have to be done, via Congress, is really on tariffs and immigration. And if I were to choose between the two, which is probably more feasible to start to get implemented first, or at least we'll get language around it first, it's probably tariffs. And when you look at the scale of what has at least been proposed on the campaign trail, which is, all conjecture at this point, we really don't know what the actual policy is going to be until maybe January 20th, which is inauguration day here. But, if you were to take all of that and what's been proposed and put on paper, at least, up 10 to 20% tariffs on all of our trading partners, up to 60% on, goods that are being imported from China. And then you look at the restriction in immigration, not just the curbing of individuals coming into the country, but also mass deportations. All of that, is a pretty has the potential to deal a pretty significant impulse, stagflationary impulse to the economy, where you get, probably a boost to inflation, but you also get a hit to growth. I say that though with the caveat that, it's probably human nature for us to look at all of these proposals, throw them up on a screen, and then say, okay, here's the ultimate hit to growth. But of course, it doesn't work that way. There's always a sequencing that goes into effect. So, our message has really been, without knowing the details, because nobody knows the details, really only Trump himself does at this point. But without knowing the details, the expectation for more economic volatility, and by virtue of that, more market volatility, should probably be raised, at least for this year. And I kind of go back to 2018 to 2019 when Trump initially engaged with the trade war with China. And a lot of the focus was on tariffs because those were really the main tool that he was using in terms of negotiation with with Xi Jinping. But when you look at the market volatility in that year, it's pretty significant. I mean, at least in the case of the US, we had a really rapid 10% correction in the beginning of the year. We had a near bear market by the end of the year. And when you even peel back the onion more and you look at some of the manufacturing data, some of the business capex expectations, some of the survey data around, businesses actually wanting to commit to capital spending, a lot of those pulled back. And even the GDP component, business investment, that component in GDP, even that started to pull back. So there was a pretty, material, not insignificant hit to, the US. It's not as if we went into a recession, but you started to see that slowing in cyclical parts of the economy. I don't think that any year is a perfect playbook for, any upcoming years. So it's not as if I think we should revisit 2018 and say that's the perfect playbook for this year, but recognizing that we're probably not going to have a year like we did last year where everything was totally smooth on the surface. I think that's a really big part of this because, a lot of investors have kind of gotten used to, minimal scarring again at the index level. And our expectation is that you're probably not going to repeat that for 2025.
Fascinating. Thank you very much, Kevin. I want to shift now to audience Q&A and starting off with the first question, basically asking, what do you think about gold in 2025?
Well, I don't think much of it because I'm not a gold analyst. I think the one thing though to keep in mind is, there's really no yield there. So I tend to, because I, like the concept of a balanced portfolio and I like income generation in general, and looking at different ways to get yield. I think there are probably better ways to do it, but we don't have a formal house call on gold. It also depends now, in this age, whether you're talking about physical gold or digital gold. So, a lot of people in the crypto space, which I don't cover either, but that's an important distinction that has been made recently too. So I'd keep that in mind. But yeah, not a gold analyst. Sorry for whoever asked that and was looking for a more in-depth answer.
It's okay. Well, speaking of yields, the next question is basically asking, do you see a correction in the stock market given multi-year highs on bond yields and investors shifting to fixed income? And then kind of a follow-up on that, do you think it's a good time to buy bonds? If so, which ones? For example, long or short-term government bonds, high yield, et cetera, et cetera.
Yeah, so I wouldn't be surprised to tackle the first question first. I wouldn't be surprised to see, a correction at some point this year. Mostly because if you look at all of 2024, a lot of the investor sentiment metrics that we track, both on the attitudinal and the behavioral side. So attitudinal being, all these surveys that ask people, how do you feel about the market? Are you bullish? Are you bearish? But then behavioral actually tracking what people are doing with their money. So, flows into equity ETFs or the put call ratio, anything in the options market. When you combine those and look at a metric that we look at from our friends at Ned Davis Research, which is called the Crowd Sentiment Poll, that particular metric, which has a really long history, spent almost all of 2024 in what is called extreme optimism territory, where things were quite bubbly. Investors were feeling pretty good throughout the entire year. Typically, when you see that kind of cluster in extreme optimism, and you only have a couple of bouts where it pulls back a little bit, kind of into that neutral zone, which is the case that we saw in 2024, that typically precedes some choppiness in the stock market. Not always the case that it's going to be an exact 10% correction or that it's going to be a bear market. But what it tells us in the way that we look at investor sentiment is it's really just showing that the market's a little bit more vulnerable to any negative catalyst that comes along. I would say probably the stronger than expected jobs report last Friday, which did result in a market sell-off, was one of those catalysts where the labor market's a little bit stronger than expected. Inflation is definitely not at the Fed's target. And when you combine those two things together, probably means that the Fed has to cut less this year, at least in the first half of 2025. Clearly, because there has been this negative relationship between interest rates and stock prices, at least in the U.S., that has been, a little bit of a negative development for the market. So to the extent that keeps happening, where inflation, doesn't get out of control, but just kind of hovers at this stickier, call it 3% average level, which is a full percentage point higher than the Fed's target. But then you also still have a relatively strong labor market that maybe fans some of those inflation fears. I could see that resulting in some kind of correction. Whether it, devolves into something worse, I think that's probably off the table for now, just because longer term breadth is still relatively healthy. But we'll assess that when that becomes an issue again. In terms of bond yields, our chief fixed income strategist, Kathy Jones, has been a little bit more cautious on duration this year, meaning, her bias is a little bit probably for the 10 year things further out on the curve, call it the 10-year treasury yield in the US to stay a little bit more elevated. So kind of hover, where it's at right now or near where it's at right now. Wouldn't be a surprise in her eyes if you get closer, to 5% at some point this year. But from an income generation perspective, I'm a fan of bonds in terms of the yields that you get now. And for many investors, especially those skewing younger, these yields haven't been seen ever. So, and if you're an older investor who's been around for a couple of market cycles, you haven't seen these yields in decades. So I think to take advantage of that and to kind of, look at the attractiveness and the safety of locking those yields in, you don't need to even go out 10 years. You can keep it more intermediate. I think that's, relatively attractive. So I'm in favor, and I think it actually argues for more of the case of, expanding beyond equities. And I say that as an equity person, to look at that for a portfolio. I think it makes a lot of sense for investors.
Yeah, couldn't agree more. I spent the early parts of my career just staring at 0% interest rates for a very long time. And
No
uh,
longer, no longer.
yeah, and now there's actually income and fixed income for a change. So that tells you everything.
That's right.
So the next question I think is asking about Charles Schwab more generally. Do you also provide services to investors outside of the US, more specifically those in Europe?
Yeah, I mean, we have coverage on international stocks that's led by, my colleague Jeff Kleintop and his team. So, and all of our stuff is available on the Schwab website. So you could just do schwab.com/learn, and you can find everything there. So Lizanne, my boss, and I, we cover the US. I mentioned Kathy, she covers fixed income, and then Jeff and his team cover outside of the US. And by the way, all of our stuff is free. So you don't have to have a Schwab account. You don't have to be logged in. If you do have a Schwab account, it's all put on the public site. And we make it, free and accessible for everybody to get access to.
Thank you very much. And then the next question is asking, given the recent volatility in the market, dividend slash income investing strategies have historically been a good safety net. Are there any ETFs or individual stocks that you'd recommend?
That's a quick answer, and it's no, because I don't cover ETFs or individual stocks.
There you
But I
go.
will say, from a dividend standpoint, as a broader strategy, if you are approaching that, area of the market, I'd be careful. It's probably look more for the sort of quality of dividends and the dividend growth over time, not necessarily just filtering for whatever company has the highest dividend. That's often a trap that kind of, some investors can fall into. So I would, be really careful about doing your due diligence on the particular company, because that's, from a macro perspective, that has tended to be, a prudent strategy for dividends is looking at the strength of them, sort of the longevity of the company, taking into account, the financials, not just screening for, okay, what's going to give me, the highest dividend.
And on that, I remember a really good study that basically says exactly that, which is basically dividend growth is a much better explainer of future outperformance than the absolute level of dividend yield.
Yeah.
High dividend yields arguably are, belonging to companies in distress, so
Yeah,
potential value
exactly.
traps there. So watch out for that. Next question, but you might have a very similar answer, Kevin, but I'm going to try anyway because it's quite upvoted. What would you say are the top five quantum computing and or AI stocks to look out for maximum growth over the next few years?
Oh wow, yeah. I mean, I can't get stock specific, but to touch again on the AI adopter theme, I think that some of the industries, if you want to look at industries or sectors to some extent that have historically had really thin margins, and in particular, post pandemic have seen their margins even grow thinner, where they really struggle with productivity or they really struggle with relatively high labor costs. And this spans everything from, this is not a particular endorsement of, groceries or airlines, but those are two industries that are kind of historically and traditionally, those sectors that have, or those industries that have, thinner margins. And they've been compressed over the past couple of years because of higher unit labor costs and because of, relatively, weak productivity. So any industry that kind of screens poorly for that, meaning they do struggle with those higher costs or that lower productivity, that's where I think that there can be more of a play from an AI standpoint in terms of how they kind of pad some of their margins and maybe improve them over time. But again, that kind of gets to doing more due diligence and doing more research around a particular company or a particular industry. If they're slower to adopt it or slower to engage with it, probably not going to see that benefit for a while. So it does argue more for a case by case, study of it, but that's sort of the nature of the beast when you're talking about a specific technology.
Thank you. And another question on quantum computing, basically saying, what are your thoughts about it, especially in light of NVIDIA CEO's comment that, any real kind of use cases are probably years, if not decades away. And I'll just add to that, obviously, the big excitement came after Google or Alphabet announced this kind of big breakthrough in quantum computing. So I guess people want to understand your thoughts on the theme.
Yeah, I would emphasize the kind of years or decades away maybe of the impact. Not as if I'm, just kind of poo-pooing it and shooing it away, but I think from an investment perspective, especially when you look at investor psyches, we often kind of think in these terms of, how can I catch that next big trade or how can I catch that, really significant swing to the upside? And am I going to feel bad if I missed it? And I think that if you kind of get caught in that, this is kind of more now psychology or sociology, but I think if you get caught in that way of thinking, it can kind of damage your investment philosophy and your investment process. So I wouldn't try to take this, all eggs in your eggs in one basket approach of how do I find that one thing, whether it's quantum computing or whether it's anything broader AI related, that's going to just completely take off because most of us just can't do that. If it were that easy, you and I probably wouldn't be here having this conversation. So I would just maybe from a this is a little bit more philosophical or maybe broader portfolio based, but I would keep that in mind when looking at some of these technologies and not thinking that there's going to be that one thing that just totally dominates and that the rest of the market's not going to keep up. It's often not the case.
Mm. Absolutely. Perhaps I'll add to that that, even if a big breakthrough is announced, there's an initial jump. That doesn't mean, these stock prices can't continue going higher after that initial kind of excitement. Just look at AI, right? Look at Nvidia if you bought, any point over the past 2 years,
Yeah,
probably would
yeah.
have
I'd
been
add,
up.
Charlie Munger, who was, Warren Buffett's right-hand man at Berkshire Hathaway's. He's sort of famous, and I might butcher the quote, but he's famous for saying, the big money is in staying invested, not trying to make some big call. And that's our ethos at Schwab, and certainly my own is staying invested over time. That's literally where the big money is made. So as long as you're adhering to that, especially from a stock market perspective, that tends to have been a pretty solid way to do this over time.
Absolutely. As they say, time in the market beats trying to time the market. So
That's
there
right.
you go. Well, I'm afraid that's all the time we have today, speaking of time. So first of all, Kevin, on behalf of myself, the entire FinMice community, and everyone attending, thank you so much. That was a really insightful and very enjoyable discussion. So thank you very much, Kevin.
Yeah, thank you. Appreciate it. Thanks everybody for joining, and it was a pleasure to be here.
Thank you very much. And as you leave the event today, everyone, a pop-up survey will appear on your screen. Please take just a couple of minutes to, fill it in and let us know what topics you're interested in hearing about in the future. Kevin, thank you once again. Thank you everyone for joining in, and I look forward to seeing you at the next event. Thank you and goodbye.